haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Navigating through the home buyer's maze, educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine. Down, the numbers make sense. Jeb shows the vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine.
Welcome back, everybody. You are going to notice we are a man down tonight. Jeb is actually out at a home inspection with one of you, some viewers here that he's been working with for several months. We're going to help with the financing, and they are out doing the home inspection tonight. So Jeb wasn't able to join us. Hopefully, for those of you who are regular viewers, you enjoyed the flashback. Without Jeb here, I was able to throw the song in there. I know a couple of you guys enjoy that. Guys and gals enjoy that. So I wanted to put it in there. We have a couple of other different things tonight. In addition to me being solo and here by myself, we are going to, for the podcast, for those of you who don't know, if you watch this live here on YouTube every week, it also gets posted to the podcast. Some of our viewers are only over there. They never come over to YouTube. So we're going to shift this up a little bit, and we're going to split it into the market update and then the live Q&A. Some people only like one or the other. Some people like both. So you'll notice I'm going to do a little transition here in the middle to make an easy edit. But tomorrow, the market update will go live on the podcast, and the following day, then we'll have the live Q&A. Should make it a little bit easier for you guys to go through and check out the content. For now, if you're watching, let us know where you're tuning in from. We always like to know, like to hear where you guys are from. Can help us tune some of this information in. But for now, let's jump right into it. And I would say, if you are here and you have a question, get your questions in now. The earlier we get the questions, the better idea we have of what we're looking at, and it can help us pace the show here. And it looks like, yeah, there we go. Josh had the wrong view there. So the topic of the show tonight is, how high will mortgage rates go? With everything going on globally, this is a big one for lots of people. What is going on with interest rates? Are they going to go higher? Are they going to go back? You know, in a couple points in the last few years, we've had rates over 7%, almost hit 8% back in late 2023 or mid 2023. So we are certainly hoping that that does not happen again, but let's break that down a little bit. This chart right here, you'll notice this is our regular chart. You can see the candlestick. We had this lovely downtrend here on the left side, that green channel where we got down under 4% on the 10-year. We had rates for most borrowers, most well-qualified borrowers in that 6.125, some even below 6% for a few days. And then everything jumped off in Iran, and now we have this big uptrend. We may, and you'll see this in a minute, we may have broken that uptrend over the last few days, but it takes a few more days and some more confirmation. And I would like to see a little bit of movement more to the downside before we claim victory here. But the red lines there up at the top, it just helps us here in terms of quantifying how much higher could rates go. So I'm actually trying to get here to a version of this that my eyes can see, because we have these numbers in here. Yeah. So at the very top, that's 4.66 on the 10-year. These technical lines here, support and resistance that I've put in here, these are from Matt Graham from MBS Live. Trust him a lot. It's one of our vetted experts here that we rely on. But Logan Motashami over at Housing Wire also has that number. Says, hey, I don't think we get above 465 on the 10-year. So far, we haven't gotten really close to it. We haven't got within 0.25% of it. But what does that tell us? We're going to see here, as of today, Mortgage News Daily is reporting that interest rates are in the range of 6.5 for most borrowers. So if we were to go from where we are right now at 432 on the 10-year to 466, that's 34 more basis points. So you're still under 7%, but you're up at that high end 6.875 for borrowers who don't have perfect credit. It could be even higher. But when we look at that, we have some resistance before we get there at 459, at 448, and that 440 level, it was broken for one day, but that gave back. So as long as we stay under 440, we should be good. If we could make a sustained move under this 428, that would be more positive. So we will see over the next week. We're going to see here in some of the slides what's been moving the market, what's been making it shift in the way that it has. So let's take a look at that here. We got some jobs data this week. So job openings and labor turnover survey, better known as JOLTS. You can see here job openings continue to decrease. We got up at a very, very high level during COVID when there were employers needing jobs, people not wanting to work because of government assistance, other reasons, just wanting to not work during COVID. And we see that that trend continues to trend down. It's not the most valuable information. This slide here is probably the better info in that report. We can see the hiring rate continues to decrease, but level there in about that 3.3, 3.4 range, but it does continue to decelerate. In terms of the quit rate, quits also decelerating. It means that employers aren't hiring people at the same rate that they were. Employees kind of know, hey, that's the issue. So if I like my job and it's pretty reasonable, I should hang out here a while. The layoff rate is the important one, the gray one, and that ticked up a little bit. So 1 month does not make a trend, but what we did see this last month, not the greatest, but also not a bad number, and it didn't just completely roll over. Now, on the other side, we got the ADP monthly report. It's a precursor to Friday's jobs report, which would be a big market mover, would normally be a big market mover. We're going to see what happens today or this week now in this market when everyone's focused on the situation in Iran and the impacts on oil prices and the impact on inflation, which we're going to look at here in a second. But we got this number, and of course, I didn't write it down. I think it was 62,000 jobs created per ADP, and the expectation was for 40. So it was a relatively big beat, but most of that was in healthcare. Healthcare gets discounted when we're looking at job info, and actually it is on there. So the actual was 62,000. The consensus estimate was 40,000, and it was almost all the beat was in healthcare. Healthcare gets discounted because it's really, it's not an economic indicator because we need nurses and healthcare jobs based off of how people's health is doing, not so much in terms of how the economy is doing. So kind of getting to the subject at hand here and how this is impacting things. This chart here, the red lines, if you dig in and look at this, the red lines basically show oil going through the Strait of Hormuz and where it goes globally. If you really dig into this chart, it also shows how many months of supply in terms of barrels that we have there, because the longer this drags on, at a certain point, we get to an issue where areas, mainly in Asia and in Africa, other parts of the world, can be running out of oil. We don't have that issue. We're pretty much self-sufficient energy-wise in terms of oil. So not as much an issue here. We'll feel it in terms of prices because the supply remains limited. But the quicker we can get this done with, the better off we're going to be. This here, I thought it was interesting in light of the last chart. So the perception, when you poll Americans, where do we get our oil from? The foreign oil, not obviously our domestic oil supply, but people think that 53% would say we get it from Saudi Arabia. Well, the actual answer is 61% of what we import is from Canada. So you look, number two is Mexico. So Americans think we get less than 30% from Canada and Mexico. In reality, we get about 70%, 4% from Saudi Arabia, 4% from Colombia, 3% from Venezuela. That number could increase. They do have some fairly large supplies of oil, but we are not directly supply-wise impacted by what's going on in the Gulf, but our prices are, because that oil ends up going elsewhere, or the other oil on the market ends up going elsewhere, and we have less here and end up paying more. So this, I kind of wanted to show, when you see that big trend line go up, that is essentially right after March 1 here, right after everything happened over there in the Gulf. This is the Sonar National Truckload Index. That basically is a measure of what truckloads are costing, and that's all because of diesel fuel going up in price. So this is a sort of a visual of showing you guys how this impacts inflation and the market as a whole, as these increased fuel costs are going to work their way through the economy. And this doesn't even touch on fertilizer and other petroleum products that are very a big impact on the world. So how does this impact us here in the US? The GDP now estimate, you can see it took a big dip down from like 3.2 to just over 2% right at the beginning of the conflict. It had recovered, and here in the last week, we're pretty much down to that 2%. So definitely below where everyone was thinking, both the blue chip consensus and the Atlanta Fed's GDP now. So if the longer this goes on, the more it impacts inflation, the more it impacts prices, the more it impacts economic growth, and the more negative it is for the economy, both for households, for you and I, to have to spend more on the things that we need, and then on the flip side, for all of that money that gets taken out of the economy for other things. So a negative all the way around. So that's a look at what it does for the U.S. economy. This here, that orange violet line there, is the 200-day moving average on the S&P index. So the last time we dipped below that was right after Liberation Day, and that kind of worked its way through, and we got back above the 200-day moving average fairly quickly, within about a month. This here is possibly a different breakdown, just because we can't our government can't just decide unilaterally that this is over. We have to have cooperation from Iran that they also are open to this being over and opening the Strait of Hormuz and the flow of oil. So just thought those are two important things there that we should be looking at. What does this tell us for inflation? So this is a big one here. I put those numbers in red and green, not because we want to evoke the look of Christmas, but more importantly, to just kind of show you that the headline numbers that include the energy costs are shooting through the roof. The core numbers so far are relatively benign, a little bit higher than they were, but not super high. So April of 2026, so March, for the CPI headline there, the Cleveland Fed nowcast is projecting 0.84 in 1 month. If we analyze that, or if we extrapolate from that, that's 10% annualized inflation on the headline. Now, if we look at it, they're only projecting it to go up to 3.25, but with another 0.59 bump in April, according to their estimates, you're looking at 3.71. We were wanting to see that moderating towards 2%. PCE behaves a little bit better. The biggest difference there is that PCE is looking at a basket of goods, and they allow substitution there in terms of what we can use in that bucket. So they say, hey, if beef prices get too high, people will buy chicken, they'll buy other proteins. So that's why it is generally more moderate. But even that, you're looking at 0.61 and 0.46 month over month, and both of those being healthily over 3%. And the core PCE also over 3%. We only have a look here. Our friends at Trueflation never let an opportunity pass by. So because they know inflation's jumping up and people are highly interested in seeing on a day-to-day basis what they project CPI to be, they're giving it on a 5-day delayed basis, which isn't super useful for us. So we're only going to show their PCE figure today, 2.48%. And if you remember, we were down like 1.18, so up 1.3% over the last month. This is, again, a nowcast. They're bringing in data and projecting really quickly what's going to happen. So this can reverse. It's gone up quickly. It can reverse quickly. In looking at this, a headline that has helped us this week, because we're going to see mortgage rates, even though oil prices are up, even though we've got a lot of negative news, mortgage rates have behaved pretty well. Part of that is because Powell sees inflation outlook in check, no need to hike rates because of oil. So they think it will work its way out. And where we can see this most clearly is we love to show this chart here of market expectations per the CME FedWatch. So really, all the way out through September, the chances of a cut are under 10%. But last week, we were up, I believe, even into the low double digits in terms of the probability of a hike. That appears to be off the table for now for the Fed based off of Powell's comments. So for now, we're looking at all the way out to June of 2027 before the market is expecting a greater probability of a cut than rates staying level where they are at. This is the chart that we started with, and again, kind of wanted to circle that, take some of those support and resistance lines out, because we're not really trying to answer the question here of how high rates are going to go. This shows us that we're at a really important inflection point. That 428 to 430 range, we broke below it. You guys may or may not be able to see, but the wick, or the bottom line on that candle for today, we were well below it at one point and haven't been able to close it. We need to break below that level to make a move lower. And if we don't, and that holds as resistance there, we're going to make a move back higher. I don't think that means a huge run up to significantly higher rates, but definitely something higher than where we're at today. So just because we've seen rates improve, do not think that, hey, I don't need to lock, or we can just let this float and see what happens. I am cautiously optimistic here, but certainly the emphasis there is more on the cautious than the optimistic. So what does that mean for mortgage rates? 6.45, so back under 6.5 per Mortgage News Daily. And what I kind of wanted to show here, so FHA, they got a 5.91, VA at 5.92. Those go to the same Ginnie Mae pools, so they're generally priced the same. It's almost unnecessary to have separate numbers. But if we look here, rates are up 0.5% over the month, down 0.03% over the week, but up 0.5% from where we were last month. But if you look, FHA and VA, those Ginnie Mae pools have performed better, and they're up just a little bit less than 0.3%. So depending on what you're looking at doing, or if you were deciding, hey, I'm going to go conventional a month ago, may push you more towards FHA, as those have been a little bit more resilient. If you're just tuning in, you may have noticed Jeb is not here. We're going to jump into Jeb's charts here in a second, give you some updates on the housing market. But if you have a question, make sure you put them in. We're still going to go through all of your mortgage, real estate, economic questions. If you have questions regarding life advice, you want anything, whatever you guys want, throw the questions up in the comments. We will definitely get them answered for you. We had some data out of the FHFA this week that you guys always seem to enjoy, so I wanted to throw it in here. This is the percentage of closed-end first lien mortgages outstanding, so out there in the wild, still in existence, and what the interest rate is. So now we are up to about 20% of loans out there are over 6%, which makes sense. We've been out there for about 3 or 4 years. We are down to what, a little under, or right at 20% of rates under 3%. A bigger number, once we go all the way up to about 50%, includes people under 4%, and then up to almost 70% of people 5% or below. So this really just comes down to, when did you buy your house? Because for the most part, unless you had a very small loan, you refinanced during COVID and were able to take advantage of one of those lower interest rates. So the next one here is percentage share of loans by borrower's credit score. This tells us we're seeing those top blue bars, that's above 780. That is becoming more and more of a percentage of the audience, the percentage of the market of people actually closing loans. So we're up about 42% of people have a 780 or higher credit score. And now when we expand to the next lower tier from 660 to 780, I wish they would break this out a little bit more granularly, because 660 is very different than 780. So if they did 661 to 700 and 701 to 780, I think we would see that not a whole lot of what's being done in that aqua tranche there is under 700. So if we look at that, that takes it down where 82, 83% of people have a 661 or higher credit score. So, and I would go so far as to say the gray bars there are people 601 to 660. Those are almost all FHA and VA borrowers. So if you're looking at a government loan, we can absolutely get you good terms there. But if you're looking conventional and you're not eligible for something like Home Ready, something where you're at or below 100% of the area median income for where you're buying, it's going to be real tough to get numbers that you are happy with. So we always want to be pushing those credit scores as high as possible to get you the best terms. So this shows a percent of closed-end first lien mortgages by the current loan to value. So we are there at, I think the number is 76.6% of people with mortgages are under 60% loan to value. This is why we say there is no mortgage crisis coming. There's no foreclosure crisis, because almost more importantly than almost 3/4 or more than 3/4 of the market sitting on 40% or more equity is the fact that only 3.7% of the market are under 90%. So 96.3% of homeowners have at least 10% equity in their home, which in almost all situations is enough to sell without having to do some type of short sale. Doesn't mean that there won't be people out there that push it off and delay and wait too long and get themselves in a difficult situation. But for the most part, when we look at that, it tells us that the market is fairly safe. So with that, let's slide into the normal market update here. So weekly inventory change, inventory up from 705,000 to 713,000. Usually the trajectory isn't quite as high as last year, but the absolute level, definitely more inventory than what we had last year, which for the most part is a good thing for the market. For Orange County and Huntington Beach, Orange County was down 0.82%. And you see that weird little hook on the red line up there. That's probably an anomaly because you see Huntington Beach was up 0.81%. So small data sets, you can get weird things. I don't think that's super indicative of anything. I'd be surprised if when we come back next week, that isn't back in line with what we're seeing nationally and here in Huntington Beach. So this here shows us single family new listings, how many new homes came on the market, 67,934 this last week, a little bit less than last year. And that can be because you see the black line was basically trending above last year's red line. It's dipped below it a little bit. But we have a thesis here that as rates trend lower, then we get more people saying, hey, I'm willing to sell and take that rate. As rates go higher, they go, I'm just going to post up here, stay in my house a little bit longer. So again, that'll be something to watch as we see interest rates move going forward. Weekly pending sales, so homes under contract, 70,209. And if we look back, 67,900, so about 68,000 came on the market, 70,000 went pending. So that's telling us that over time, we're going to see less net inventory on the market if that trend persists over time. So this one here is percentage of properties with recent price reductions, trending pretty much in line with where we were last year. We had been below last year's levels. And as you can see, as rates sort of pop back up, we're right in line with where we were. It's 34.07% of homes are having a recent price reduction. The spread, as you can see, we had that dip early in the year where we got down to about 1.8%. We're back in that 2% range, which is still relatively good and healthy. That tracks very closely the volatility in the mortgage market, and we are having a ton of volatility. That easily could have spiked, and if so, rates could have been a good bit higher. So kind of going back to the topic of tonight's show, how high will mortgage rates go? That would be something for us to pay very close attention to, because if the spreads blow out and get higher and the 10-year were to go to the high end of that range, we could be back in the 7% range or low sevens if it all broke against us. So from that end, it's definitely something to bear in mind and watch. A reminder for you guys, if you're watching and you're considering buying, this is one of the most valuable things that we do. Try to do it every couple, 2-3 months. But this is the Educated Homebuyer Workshop, where we go through our comprehensive plan in about 90 minutes. Hopefully we try and keep it a little bit less than 90 minutes and go through and show you, tell you, demonstrate for you everything you should be doing to build a team, get yourself pre-approved, pick the right loan program, find the best home for you and your family, and negotiate a deal without getting squeezed on price. So from that end, definitely think it's valuable. We're doing it April 14th, the day before tax day, 5:30 p.m. Pacific, 8:30 Eastern. Try and give the widest range of being able to get all of you in, no matter where you are in the country. So if you haven't signed up for that, definitely register now if you are in the market. So as I said, that is the market update for this week. We're going to do things a little bit differently. If you're listening on the podcast, we're going to come back tomorrow with charts. Obviously here on the live show, we're going to go through the Q&A, but we'll be back tomorrow in the podcast feed with the live Q&A. Some of you had asked to have it separated out to keep the episodes a little bit lower and make it a little bit easier for you from that end. All right, so welcome back to the Educated Homebuyer. The market update is in a separate episode. You can refer back to that if you're listening in the podcast, but we are going to jump into the Q&A section. We don't have a ton of questions in here, so if you have a question, make sure you get it listed. As of now, let's jump in. We have Marcus, longtime viewer, new homeowner, educated homebuyer, became a homeowner, says, thanks for the great info, Josh. miscellaneous of the whatever. A regular viewer says hello from Vegas. Hopefully you're not losing all your money out there in Vegas, staying out of the casinos. VIP, top of the food chain viewer, Dixieland Productions says good morning or good evening. Good morning. Good evening, listening from Minnesota. Thanks for the notification and smashed the thumbs up. So let's jump in here with the first question of the night. Stephen M. says, my fiance and I are looking to get into our first house. She went from W-2 to a new job 5 months ago that is 1099. We both have 780 credit scores. Then the follow-up is our pending marital change something to consider when applying for a loan? Second, will the 1099 be a limiter when applying for a loan due to her being with that specific job for just the past 5 months? Let's take the second part because it's easy. The second part is one that we don't get a lot, so I like the question. But let's take a look from the front end there. A problem is it a problem to go from W-2 to 1099? It absolutely is, because 1099 is an independent contractor. Unless your wife to be has an entity set up like an LLC or an S corp, she is going to file a Schedule C. And even if she has the entity is going to do an 1120 tax return, a business tax return of some sort. And that says, okay, here's how much money came in, but we also had expenses in generating that income. So we do not have that. If she started that 5 months ago, it was just there at the end of the year. At a bare minimum, we're going to need at least a full year on the tax return if we're in the same line of work. Hopefully it wasn't a line of work change. It doesn't sound like it, but a well-qualified borrower staying in the same line of work with 1 full year on the tax return, we can generally make that work. But you're not going to be able to use her income on a full doc loan, at least until next year's tax return is done. So always tell people, be very, very careful from going W-2 to 1099. 1099 to W-2 is not a problem because you're doing the opposite. Hey, I need to declare my expenses on the tax return previously, but I'm not doing that anymore. I'm getting a W-2. So if the employer will give a verification of employment that says, hey, Susie makes $5,000 a month and she's paid every 2 weeks, and we have a couple pay stubs showing that, we can use that almost immediately. So if we want to buy for the rest of the year and we're looking at not putting a large down payment, where something like possibly a bank statement loan would be possible, it's going to be a little bit difficult for you. So let's look at the other piece of that question. You said, is our pending marital change something to consider when applying for a loan? For the most part, no. It used to be in the 70s, back in the olden days, the Ron Burgundy days, when they could say, hey, you're a female, are you going to be having a baby anytime soon? Or you're of childbearing age, we can't do that. Or they could look at old people and go, hey, you're old, you might retire, we don't know that you're going to make money for the next 30 years. Those things could be an issue, but for the most part, they can only look at the current situation. You know, same-sex couples, unmarried couples living together, recently married, soon to be married. The only area where I can see those, what I was saying is they all need to be treated the same. Everyone has to be treated fairly. Everyone has to be treated equally. So the only area where I could see this being an issue for you would be if you were looking at government financing, FHA, VA, USDA. If you are in a community property state, if you guys get married and you were to try and qualify on just your income, you have to count non-borrowing spousal debt against the borrower. So that could be something if you were to try and pull it off with just your income and you were using government financing, because it gives you a little bit more leeway, a little bit more room in terms of the debt to income ratios. That would be a situation where you would want to be careful. You might want to try to buy before you get married. So we've got another one of you listening here from Montrose, California, Kamui Connors. So thank you for watching. Appreciate the support. Hopefully we're getting you some good info today, but we definitely have a few more questions coming in. Mr. Bulov, I love the name, love the screen name, Mr. Bulov. I have a question. Got a new construction home 5 months ago. When should I challenge property tax with my townships? So once it comes in or before the full assessment? I think they may require you to wait until you have the full assessment. The best way is to reach out to the township, tell them what you're seeing, what you're thinking, and what you believe you're going to challenge. But if they haven't done the full assessment, they may say, hey, you got to hold your horses. You got to wait and see what we're going to assess it at. Situations with new construction can be very weird because a builder generally buys a parcel for a relatively low price. And so when they split off that parcel, the apportioned tax rate can be very, very low. And then obviously now there's an improved home on there and the assessor has to go back and say, hey, this lot with this home is worth a lot more and you owe us more in taxes. Sounds like areas may be leveling off or even decreasing in your area and you're concerned they're going to overassess it. But I would absolutely wait until you see the assessment on that. So question here, Nicole Jensen's says, can you do a streamlined FHA refi without touching the interest rate? For example, lower or extend the term. This is so infrequent that I cannot answer this one off the top of my head. I believe that by shortening the term, that can help you qualify. But I'm not certain on that. In general, the guideline is you have to save 0.5% in the interest rate. That's what they're looking for, 0.5% or more in the interest rate to make it eligible for a streamline. So I have a wonderful GPT set up here. Let's just ask this while we're going through it. Can we do an FHA streamline to 15 years without lowering the rate? That'll come back with an answer here for us here in just a second. I'm worried that it's going to stick you with the 0.5% requirement regardless. So in looking at it, yeah, the new rate must be lower or the refinance must meet other strict net tangible benefit requirements. So reach out, shoot me an email. I'll be happy to research it and get you an accurate answer. But they are fairly strict with that because they're not verifying income and assets. They don't want brokers just reaching out and ripping people off and saying, hey, we're going to save you 0.1%. They want there to be a true net tangible benefit to you. Well, look at this. The Dixieland Productions come back and says, appreciates the VIP designation, but the real VIPs are you and Jeb for all the time spent sharing valuable information. Well, we appreciate it. Everyone watching may not love all of the love in here, but let's get over here. We've got another good questions. Gil GDF says, hello, what are average rates for DSCR loans? So the debt service coverage ratio loan is a loan that instead of using pay stubs, W-2s, all of the normal income and asset docs for you to qualify, they're going to look at the rents that the property generates. And a few years ago, when they first came out with and introduced these for residential properties, residential investment properties, so 1 to 4 units, we needed like a 1.25 debt to income ratio. So meaning if your mortgage was $2,000, we needed like a $2,500 payment. Now we have debt service coverage ratio loans that have no ratio. So a no ratio DSCR. That sounds insane to me, but they do exist. So the biggest thing in determining what your rate is going to be is how low is your loan to value, how high is the debt service coverage ratio, and then how good is your credit. So someone with an 800 credit score and a 50% loan to value and say 2.0 debt service coverage ratio could be very close to what we're seeing in terms of the Fannie Freddie rates. Maybe you're paying 1/8 or 1/4 in premium, sometimes even better, because those lenders have so many other loans with lower credit scores, higher LTVs that they put in their pools that they sell, that having those super valuable low LTV, high credit score, high DSCR ratio loans helps the weighted averages for the pools. So very, very hard to answer. So anywhere from very close to market rates to easily at least 2% above. So if you got a 680 credit score, a 1.0 DSCR, and an 80% loan to value, and it's cash out, you could easily pay a couple percent above market for that. All right, guys, you are slacking on the questions tonight. Again, Jeb and I wonder if we've answered all the questions for you. So if you're out there, you have a question you want us to go through, I guess it's not an us tonight, it's just a me. So we've got plenty of time here to answer your questions. Throw them up and we will get through them. Trying to think what would be valuable for you guys. We are working on some interesting stuff here for the podcast going forward. We recorded a really, really valuable episode today. When we were done with it, both Jeb and I looked at each other and said, that could actually, we could put a PDF together, sort of a recap of that for buyers because it's so valuable. And the interesting part, I gotta look back over here and see who it was, but it was a suggestion from a listener. So if you're here and you've looked at the podcast, you've looked at all the episodes, you've been following along, and there's something that we haven't covered that you want us to cover, post it here in the comments. Better yet, shoot us an email at info@theeducatedhomebuyer, because we would love to go through that and see and build the episodes that you guys want to hear. But what we covered today is what sellers are looking for in an offer, because buyers often default to, hey, all the seller cares about is the price. And price is obviously very important, but truly the net profit should be considered, the risk to them in terms of contingencies, the risk in terms of timelines, how much money you're putting down. So it's a very good discussion where Jeb and I go through that. It will be live on Monday. So if you are interested and are thinking of writing an offer sometime soon, again, I think all of the episodes we do are valuable, or we wouldn't record them, but it was especially valuable. I think you will enjoy it. Steven says, thanks again and love the hat. You are very welcome. We are definitely here to answer any and all questions. I like this hat too. It's one of my favorites because it looks black, but it's actually, it's camo. You just hard to tell looking super closely at it. So let's look here. Another Scott Weemet. That's funny. I used to have a friend who was married to a Weemet, and her brother was Scott Weemet. So been watching you for a while, and finally got into my first home in February. 290,000 at 5.5 rate, appraised at 325. Got in with zero down with down payment assistance. Paid off one of the down payment loans already. So I'm not sure if Scott has a question. He follows up and says, thanks for all the knowledge that you guys share. Here's what I would say. Scott did something very, very important. If you're going to use down payment assistance, for the most part, down payment assistance that comes from the housing and finance agencies, they almost always do them in the form of a second, and for Cal HFA here in California, a second and a third, and most of them will not subordinate. So let's say they're giving you an above market interest rate to help subsidize the cost of the second and or third mortgage they're putting against your property. You have an above market interest rate. If rates drop, you're going to be highly interested in refinancing. So whether that's Florida Homes for Heroes, whether it's Cal HFA here, whether it's a T-Shack loan down in Texas, all of this stuff, if you can, you want to get that second off there as quickly as possible so that when rates cooperate, you are able to refinance. Because I get calls from listeners all the time. I actually have a listener I've talked to 3 times so far. She set up another call for tomorrow because she's been saving money to pay them off, because I want to say she's in like a 7.5% interest rate and wanting badly to get out of that. So Scott, thanks for watching. Thanks for letting us be a part of it. I'm glad you were able to get in and glad you're doing the right thing there. So, Steven, look at me screwing up. I thought we had a Scott. We just had a Scott, but I thought we had 2 Scotts. Steven follows up and says, so my fiance and I most likely can't get into a house until she has worked for the company for 1 year, ? She may convert to full-time in a couple of months. My salary is $68,000. With hers, we're at $130,000. So most likely, unless you're in a very low-cost market, you're going to need both incomes, and no one is going to be able to let you use that income with 1 month of 1099 income at most on a tax return. There's just no way to properly analyze it and know what expenses she's incurring to generate that 1099 income. So yeah, if she could make that shift back to a full-time employee and W-2, you shouldn't really have any wait or delay. You'll just have to show the 1099 income and that she was receiving it. But for the time being, you could definitely be in a tough spot. So we have a comment here, professors on 8795 says, I got my first mortgage at 12%. I'm seeing the same thing about to happen right now. I will personally eat this phone here on air if we get to 9%. How about that? We have seen the absolute worst case scenario when rates approached 8% a couple of years ago. There is absolutely nothing going on. If the Strait of Hormuz never opens again, we would not see 12% interest rates. Within 2 to 3 years, much like you saw the shutdowns, maybe you guys remember, maybe you don't, when Russia attacked Ukraine, large supply of the world's grains comes through the Black Sea, and we're like, the Black Sea is going to be shut down. There's no way to get stuff through there. there have been multi-pronged solutions over the last few years so that that is not an issue and grain prices have not gone through the roof. We're going to see the same type of resilience. We will never have another conflict again in the future where anyone can shut down the Strait of Hormuz and be a problem like this. There will be different pipelines, different shipping routes, and a much more resilient global oil supply going forward. So appreciate the insights. Definitely a concern, definitely something to keep an eye on, but there is about zero chance of ever seeing double-digit interest rates short of Armageddon. All right, we got another question here. My sunshine girl. I like that. I like my sunshine girl. Recently divorced. So now you're about to be someone new's sunshine girl, I see. So recently divorced. We'll be selling our house. We'll have some equity. I'm trying to decide on using it to buy a townhome for myself or use an FHA 203K to buy a duplex or fourplex. Very, very different questions. I would ask yourself one of two things, like how comfortable are you with that construction process? I don't mean you swinging a hammer. I mean running and managing a contractor. For the most part, I don't have clients who are interested in managing and running a job and staying on top of a contractor. We see more horror stories than success stories. That being said, I have a client who literally will be closing tomorrow morning, and he has a buddy who's a contractor. They're going to go in and gut the house the very first day. This is someone he's done houses with before. He's the zero concerns. He's very happy with it. He gets to take a dated home and make it perfect the way he is. And coincidentally, that gentleman also went through a divorce. So he's taking his proceeds, his half of the proceeds from the sale of his house, buying a new home in a neighborhood very near his old home and dialing in this new home. So can it be an option? It can absolutely be an option. So the 203K and duplex or fourplex, I would almost even say turnkey duplex or fourplex versus a townhome, very, very different. Financially, the duplex, the fourplex is going to be much easier on your wallet. The townhome is going to be more privacy. As a single woman, you're less likely to have concerns about maintenance and upkeep. That can be good. You might not want to live in a fourplex with three other families. Again, as a recently single woman, it may be something that you have zero concerns with. It may be something you don't want to deal with. So much here from the loan side. Really just sit down with a mortgage professional. If you're in one of the areas that we service, you can use the link down below there, jebsmith.com or jebsmith.net/start. And if you're in one of the states that we service, you'll get connected with me. If you're in a different state, we can connect you with one of our trusted, vetted experts that operate just the way I do on the mortgage side, because really it's equally a mortgage and financial question as it is a question of what you should be doing and what's best for you personally that only you can answer. But I definitely find that getting the numbers laid out and seeing what the options look like gives most buyers a greater comfort level to make those types of personal decisions. All right, Scott Weemet back with the details. I like it. Second and third mortgage, 10,000 at 0% and 6.5% at 7%. Paid off the 6.5 before my first payment. So sounds like that probably wasn't even necessary. You possibly could have done it, or maybe that was just timing on that money coming in. So very good to get rid of the higher interest one. The 10,000, hey, you pay it off when you can pay it off. A tax return, a bonus. Do it over a couple of years. You're not paying any interest. And even at that, if you're in an area that's still appreciating, just that $10,000, you should be able to get to an equity position where you might be able to refinance far sooner than having 16,500 out there. My sunshine girl follows up with I'm a longtime nurse. Nurses do well, make good money. Hopefully you get that wonderful 312 schedule where you have 4 days a week to yourself to be able to enjoy. Don't know that it really impacts the decision there other than just, again, your comfort level. How do you want to live? How closely do you want to live with others during this process? Do you want to manage a contractor? Do you want to be a property manager? So to me, I almost lean towards just from a distance without the two of us talking. I like the duplex idea. Gives you a little bit of rent. You're not living with 4 families around. Probably a little bit easier and faster for you to go in and do a rehab if you decide to do that. But also don't discount buying a turnkey duplex if that's an option for you. It's a good question. So Retro 415. Thoughts about changing lenders. Hate stringing them along and all the work doesn't close, but as someone refinancing, I look for what's the best for me. I follow the golden rule. Don't mistreat people who've treated you well. If you're in the process, you don't like the way it's going, by all means, raise the concerns with them. Let them know. Give them an opportunity. There are things that happen. We don't perform perfectly. There are times when we get buried, overwhelmed. You get a couple of really difficult files, and maybe the normal 2-hour turn time on getting a call shifts to the next day. So you never know what's exactly going on. Closed a deal with a realtor last week, and she kind of went MIA towards the end of it. And you're like, what the heck's going on? Turns out her sister had an emergency kidney replacement, and she had to fly across the country and be in the hospital with her. So you never know what's going on with someone. Try and put yourself in their shoes. Give them every opportunity to earn and keep your business. In general, in terms of rates, you're saying close, but as someone refinancing, I look for what's best for me. Unless that person didn't lock your interest rate a couple of weeks ago, there's no world where switching lenders is going to be positive for you with rates up 0.5% over the last month and probably half of that over the last 2 weeks. So it's not a situation where you locked a rate and rates have got a bunch better and you're looking at, hey, what's my float down option? How do I take advantage of what's moved down? So I would say start with a conversation. Don't be afraid to have what you may think is a difficult conversation. I always welcome it. If someone has a concern, tell me about it. Let's talk about it. I can tell you what's going on this end. I can tell you what we can do to resolve it. And if we're not the best fit to resolve it for you, by all means, go and find someone that's going to work for you. That very, very, very rarely happens, but there are situations that do come up. So we got one here, and this almost dovetails with the episode that we have going live on Monday. Real Mad 46. Don't be real mad at me 46. Sellers seem more open to negotiating lately. Phoenix area. In your opinion, is now a good time to buy, or would you wait another year? Does the current market mirror anything we've seen in the past? We have some good friends out in the Phoenix market, an agent that Jeb is close with. We have access to the Cromford report that gives us really good data out there. And we have a past guest of the show who also runs an economic report on the Phoenix market. And with that, he had a Substack last week where he basically said the Phoenix market hasn't really gone anywhere in the last 4 years. Now, that being said, your mileage is going to vary. The Phoenix metro is fairly large. There are areas that have done well and have seen some appreciation. There are some areas that have not done as well and have dipped a little bit. For the most part, it's kind of gone sideways. I definitely think it is a market with good demographics. It is a market with a lot of potential growth. Many Californians gets priced out and they like to be 4.5 hours away instead of 20 hours away in other states. So I always ask this question, answer this question with a question. Wait for what? What are we waiting for? Do I think there's going to be something massively different next year? I don't. We didn't see this Iran thing coming. We thought this year was going to be not a ton better, but a little better. Logan Motoshami, again, over at Housing Wire, his model had about 250,000 more sales this year than last year. So that's better. It's not great. It's better. That was what we were expecting and should be pretty consistent across most markets. If you felt like next year is going to be better for you, you're going to save more money, you're going to improve your credit, you're going to have a better job, you're going to get married, you're going to get divorced, whatever change is coming along the line, I don't see a huge pressure to do it now. But in general, we want time on our side, time in the market versus timing the market. So let's leave it with that. That would be my best advice. If you think now is the right time in your life to buy, I don't think that next year is going to be a better entry point. Now would probably be the time to do it unless there's something happening in your life that is going to change between now and then. We got Mr. Nice Guy. We got Real Mad 46, and then we go straight to Mr. Nice Guy. I like this. Hello again from Missoula, Montana. Is an 18% below listing offer on a 200 plus days on market house going to be considered offensive? Seller has had no offers. I don't think it's offensive in any way, shape, or form. The question just becomes, do they bother to respond to it? They didn't put it on the market and not get offers because they're reasonable and open to things. They've been putting out signals directly or through their agent that, hey, we're not interested in coming off this price. I think it's unique, and maybe I'm okay with it taking 2 years to sell. If I would consider less the days on the market. then what is the true market value? Are you and your agent going through and comping this out and saying, hey, I think 18% is the right number. Here's 3 homes that are very similar to it that sold at this price. I think this is the price you're likely to be at. Now, if you guys comp it out and you say, hey, it's 10% overpriced, but it's been on the market for 200 days, let's make them an 18% below offer because they might be desperate. They're clearly not desperate. Someone who's had their house on the market for 200 days doesn't have to act rashly. They're more likely to be irrational than they are likely to be desperate. So from that perspective, comp it out, go through it with your realtor, make an offer that you think is reasonable for that home. And maybe it's below what's reasonable because you think it softened them up the 200 days. But if you go in way below what the market is telling you the value is, this person is telling you they are not in a rush to sell. So again, another one of our most common questions. Retro 415 says, when would it make sense to do a refi in terms of rate savings and time to recoup the refi costs? I have a listener here that I'm going to be talking to tomorrow. He wasn't available today. They have a property in Alabama, and it's a rental property. And he said, I want to do this. It's a $170,000 loan. We bought it when rates were high. I need to save at least 1%. So we go and look at our rule of thumb, which is 125,000 divided by your loan amount, and it tells you how much you need to save. So for that, if we run 125 divided by 170, he doesn't need to save 1%, but in general, a lot of the closing costs, title, appraisals, they have a floor on them. They don't get cheaper for smaller loans. So that bar is almost higher on the low end. So for him, I think that 1% would be reasonable. Now, again, let's say if that's a $500,000 house and you take our rule of thumb, it tells you only need to save about 0.25% for a 0 point or no cost loan to make sense. So those are the kind of the things that we're looking at. I've seen people do a no cost refinance for 0.25%. It was a bigger loan and it saved them some money and it made sense. And we generally try to keep those on track instead of realizing payment savings by starting back over on a 30-year amortization. We line that up with where they're at currently. But you got to look at a couple of things. What is my monthly savings? What is my total cost of the loan? Be careful of taking that total cost and just dividing it by the monthly savings, because some of that savings is coming from, if you got that loan 2 years ago, you currently have a 28-year loan, and now we're comparing it to a 30-year loan. Make sure your loan professional is going through that with you. If you want someone to walk through it with you, we can do that. We can then put a number in that's a strike rate that, hey, we're not there today, but as soon as we hit this level, we're going to do it. Use that link below, jeffsmith.net/start. You'll get connected with me and my team, and we will make sure we run those numbers and go through it with you. Because again, that's a rule of thumb that we use, but it is not a hard and fast rule. You need to be comfortable with what we come up with. So sometimes we'll adjust it higher or lower based off of the preferences of the borrower. So Jerome Ventures, hi, I got my new construction home at 5.25 fixed in Covina, California. Do you think I'll ever have to refinance? I go back and sort of relate this back to the last question. It's not a matter of have to refinance. The question is, do you think I'll ever get to refinance? Do I think it's out of the question? No. If I'm a betting man, I'd say 2-to-1 odds that you're going to have that for quite some time. We were trending down below 6% earlier this year, and that's still 0.75% from where you're at. So really would have been, you need to be, most likely we run that rule of thumb. Most people want to save at least 0.5%. So 475, is 475 likely in the foreseeable future? Not until we get some real weakness in the economy, not just sort of this muddle through economy, but real weakness in the economy, combined with some really benign inflation figures. And we haven't been able to get down to 2%, much less under 2%. So with that, do I think you'll get a chance to refinance? 2-to-1 odds, no, but that's still a 1 in 3 chance says that you would be able to refinance. And some of it comes down to, hey, if it's 15 years from now, you may have that thing paid down a ton and the loan's really small and you're saying, hey, I want a much bigger savings, or I just don't want to start back over. So a lot of things come into play. You want to run the numbers. You want to work with someone who's not trying to sell you a loan. They're trying to help you analyze your situation and what makes the most sense to improve your financial future. So we've exhausted all the questions here. We do have a few more minutes. So if you have one, throw it up. I'm definitely happy to answer a few on the way out. A reminder for you guys, let me get this back in here. April 14th, the Educated Homebuyer Workshop, the Educated Homebuyer's Blueprint, where in a little bit less than 90 minutes, we walk you through everything you need to know to buy right, borrow smart, and build wealth. And soup to nuts, A to Z, go through it pretty quickly. We give you some really good bonuses, a couple $1,000 in savings available to those that attend. The biggest thing is what I have heard from people who we've been able to close loans for who've gone through this. They're like, that was a really smooth and stress-free process. Is it because of anything we did there? It's less about what we did there and more about the information, the knowledge in your head. When something is clear, laid out, direct, and you have that roadmap, it just makes them smoother and stress-free. So along those lines, would love to say here, that link below, jebsmith.net/start. Our team can help in about, I believe it's 38 states now. That covers about 90% of people that inquire. There's a very good chance we can help you on the mortgage side. If you have any mortgage needs, any mortgage questions, we would love to talk to you. It's not just about pre-approval, certainly not just a rate quote. We're certainly not trying to sell you anything. What we try to do is build the BuyWise roadmap for anyone that we talk to. Tells you what your purchasing power is, AKA what is your max purchase price. It gets numbers of where your comfort level is. What do you want the payment to be? What do you want the price point to be? And the best option for you with that. And then if it's appropriate, we can get you connected with a vetted real estate pro from Jeb's network. And I can vouch for them. Everyone that I've ever worked with closing a loan who Jeb's connected someone with, it's been a very good process. They are professionals that follow the same processes here that we talk about are important for you. So we've got one, Mav93, Angel93. Good evening. I don't have a rate question. Could you give a brief summary of escrow surplus refund? My first time going through it and would love info on it. What can I use it for? So if it's a legit and true surplus that they are refunding to you, that is your money, you can do anything you want with it. You're going to get a check back. What I would say is I definitely have concerns for my clients in California. What is an escrow surplus? A lender can only keep by law a certain pad in your impound account. So they can collect enough to pay your taxes and your insurance over the next 12 months when they come due, plus a small pad. And they have to do an analysis at least once a year where they are repaying you or recrediting back to you any excess that they would have. So at closing, that analysis is what's called an aggregate adjustment. If you've been through the process and you've seen, what is this credit to me, this aggregate adjustment? It's a refund that makes sure that the lender doesn't have too much money in your impound account over the next 12 months. Well, every 12 months while you have that, they have to do that analysis and come back and go, okay, it looks like we're gonna have too much, and we're going to make you a refund, or we're going to have too little and you need to either pay us a lump sum to make sure that we have enough in it over the next 12 months, or we're going to add X number of dollars, that amount divided by 12 over the next 12 months. So that's the surplus, that's the refund, that's the cost of a shortage. Why I say in California, we have Prop 13. So if you buy from Grandma Gertrude, who bought her house in 1970 for $43,000, she might be paying on an assessed value of $80,000. And if you pay $700,000 for an $80,000 house, you're going to get assessed. Your lender is going to set up the file charging you the proper amount of taxes for the $700,000 purchase. What I've seen is in that first 12 months before you get reassessed, we have someone out of state does that escrow impound account analysis, and they run through and they go, oh, this is crazy. We're going to have thousands of dollars too much. Here's a $6,000 refund. What they don't realize is that you're going to get hit with a supplemental tax bill, and that is the actual correct amount that was set up. So those are the important things to look at. So Mr. Nice Guy here follows up with, that would be true market value. Seller also has a property in mind to purchase. So am I remembering correctly, Mr. Nice Guy? You're in Missoula. So the true market value is probably what they're looking to get. So this is an area where if the property is listed, you're going to want your realtor to reach out and feel them out. What are they open to considering? What offers have they seen? Have you got verbals? Have someone, what showings are you seeing? You know, hopefully the agent that is representing that seller is going to play ball and give you enough information to know where you're at. You know, you need to determine the true market value and then figure out what is this home worth to you, because the true market value obviously is less than what he's asking, unless it's a very unique property and it just takes time for the right buyer to come along. So if the seller is getting more motivated because they have a property in mind to purchase and they may be risking it or losing out on it, now their motivation may be creeping up. I don't think 18% is offensive, but I wouldn't just willy-nilly go and throw an 18% below market offer out to them without having your realtor reach out and get some reconnaissance on it and get some info before we do that. So Real Mad 46, come back. Thanks for all the valuable information. I'm never mad at you guys. You guys are awesome. So we appreciate that. He says it's short for Real Madrid. That makes more sense. I'm happy that you are not real mad. So we're going to end it on that. That is the last question of the night. Appreciate you guys listening to one dude talk for an hour, since Mr. Jeb had to be out with Johnny and Maritza tonight. Hopefully that home inspection went well. Hopefully a few others of you reach out. We can help you get into homes, and he'll be out on another home inspection in a few more weeks. So again, appreciate you guys showing up. Appreciate you asking the questions. For those of you on the podcast, remember, this is the second half. It's just the Q&A. We're splitting them up going forward. So Thursdays, we will have the market update, and Fridays, we will get the Q&A. So we'll be having 3 episodes a week. Monday mornings, 5 a.m. Pacific, the weekly episode goes live. Thursdays, you will have the live show. Fridays, you'll have the live Q&A. So we're going to say the live show. Thursdays, you will have the live market update. Fridays, you'll have the live Q&A. Again, if you guys have any questions, you can reach out to info@theeducatedhomebuyer.com. If you're ready to get started, go to jebsmith.net/start. We would love to help you guys. If you have ideas, show topics, things that you want us to cover, throw them out. Here, for those of you who have made it still to this point in the show, what I would also love, if any of you have bought a home in the last 3 to 6 months, you've been listening to the show, you benefited from it. We are going to be starting a new series going forward where 1 episode a month, we're going to do a breakdown, which is basically an interview with one of you who have gone through the process about what worked, what didn't work, what you wish you knew, basically laying it bare, not to lay you bare, but to lay out all the information that you guys could benefit from hearing that. So if you're interested, use that same email, info@theeducatedhomebuyer.com. If you would be interested in doing one of those episodes, we would love to have you. Otherwise, check out the new episode on Monday. Come back next Wednesday for the live show, where hopefully both of us will be here. Until then, buy right, borrow smart, build wealth. Adios, amigos.